Um, Good evening. Now we are having a presentation on development overview of the newly introduced standards of accounting, most specifically IFRS 16, which talks about lease. IFRS 16 came into effect on 1st January 2019, which represents a significant update in lease accounting, replacing the previous standard, which was IS 17, and related interpretations, that is IFRS, IC 4, CIC 15, and CIC 27. Now, the new standard introduces a single accounting model for leases, removing the distinction between operating leases and finance leases for lessees. Under IFRS 16, lessees are required to recognize most leases on their balance sheets by recording a right of use asset and a corresponding liability. We now focus on rationale and objectives of IFRS 16. So the rationale behind the introduction of IFRS 16 was to improve the transparency and accountability of financial statements by ensuring that lease obligations are clearly reflected on the balance sheet. Now, under IS 17, operating leases were off-balance sheet transactions for lessees, making it difficult for investors, analysts, and other stakeholders to assess the true financial position and leverage of a company. Now, the primary objectives of IFRS 16 are as follows. Number one is to enhance transparency. This is done by bringing all the leases onto the balance sheet. IFRS 16 provides a more accurate picture of a company's financial position. Two, it focuses on consistency and comparability. In other words, it eliminates the distinctions between operating and finance leases for lessees, making lease accounting more consistent across companies and sectors. And number three focuses on better information for decision making. This entails the recognition of lease liabilities, ensures that investors and creditors have a clear understanding of the financial obligation a company has entered into. Now, we do have some key differences between IFRS 16 and IS 17. Number one, we're looking on the part of lease classification that I see. Now, on IS 17, the lessees classified leases as either operating leases or finance leases. Operating leases were off-balance sheet, while finance leases were capitalized. While IFRS 16, there is no distinction between operating and finance leases for lessees. All leases with limited expectations are capitalized on the balance sheet, meaning lessees must recognize a right of use asset and a lease liability. Coming to balance sheet treatment, IS 17 states that under operating leases, no lease liability was recorded on the balance sheet, and the lease expenses were treated as operating expenses in the income statement. IFRS 16, all leases result in the recognition of an asset, right of use, and the liability on the balance sheet. Now, the lease liability is initially measured at the present value of lease payments, and the right of use asset is measured at cost, including lease payments and initial direct cost. Moving forward, we now look at income statement impact. When it comes to IAS 17, lease expenses for operating leases were recognized on a straight line basis over the lease term, while IFRS 16, lease expenses under IFRS 16 are split between depreciation of the right of use asset and interest on the lease liability, resulting in a front-loaded expense pattern with higher expenses in the earlier years of the lease. We have got some exemptions to some of the differences. Looking at IFRS 17, lessees could apply the operating lease treatment to leases with a term of less than 1 year or leases of raw value assets, while on IFRS 16 provides similar exemptions for leases with a term of 12 months or less and leases of raw value assets. But lessees must still recognize the lease liability and the right of use asset, albeit with simplified accounting. Coming to sale and leaseback transactions, IAS 17 states that sales and leaseback transactions under IAS 17 were governed by a complex set of rules, including the need to assess whether the transaction was a sale under the standard. On IFRS 16, it introduced a more straightforward approach for sale and leaseback transactions, focusing on whether the transfer of an asset meets the definition of a sale. We have got some potential impact on financial statements and business operations. Balance sheet impact. The most notable change is the requirement for lessees to bring all leases onto the balance sheet. This increases both assets, right of use assets, and liabilities, which can significantly affect financial ratios, including the debt to equity ratio and return on asset. Impact on income statement. The shift from lease experience recognition on a straight line basis to depreciation and interest expense results in a front-loaded expense profile. This could affect profitability, especially in the early years of lease contracts. Companies may also experience changes in tax treatment depending on how the lease payments are structured. We also have some impact on cash flow. Now, the classification of lease payment is changed under IFRS 16. Under IAS 17, operating lease payments were treated as operating cash flows. Under IFRS 16, lease payments are split into principal and interest components, which with the principal portion classified as a financing activity and the interest portion as an operating activity. Moving forward, you've got also on operational decisions. Businesses may reconsider their leasing strategies. In particular, companies that relied heavily on operating leases may now need to reassess the financial impact of leasing versus purchasing assets. There might also be increased pressure to negotiate lease terms or move forward towards shorter term leases to minimize balance sheet impacts. There is also an impact on investors' perceptions. With the new accounting treatment, companies may appear more leveraged even though the operational nature of their leases has not changed. This could impact their cost of capital or affect stock prices if investors react negatively to higher reported liabilities. There are also some challenges and criticisms of IFRS 16 and its implementation. One of the challenges and criticism that is associated with the IFRS 16 is its complexity and the cost of implementation. This entails that implementing IFRS 16 requires significant changes to accounting systems, processes, and internal controls. Businesses must track and assess all leases, which may require significant resources, particularly for companies with a large portfolio of leases. The cost of adopting the new standard, including system upgrades, training, and consultation, can be substantial. Another challenge and criticism is lies in subjectivity in measurement. This tells about determining the lease term, discount rates, and expected residual values, which can involve significant judgment and subjectivity. This introduces potential variability in how different companies apply the standard, leading to inconsistencies and comparability issues. We also have impact on small and medium enterprises, SMEs, which entails that while larger companies typically have more resources to manage the implementation of IFRS 16, SMEs might first glitter challenges in terms of both financial and administrative burdens. The exemptions for low-value leases and short-term leases offer some relief, but smaller firms may still find the transaction to the new standard difficult. On investors' confusion, some investors and analysts have expressed concerns that the new standard may lead to confusion regarding the true economic impact of leases. The increased lease liabilities could distort key financial ratios, and stakeholders may need additional education and classification to properly interpret financial statements under IFRS 16. There is also flexibility in lease structuring. The standard has also been criticized for potentially discouraging leasing as a financing option, as businesses may seek to avoid the impact of capitalizing leases by structuring them differently, such as opting for long-term leases or using alternative financing method. Now, in conclusion, we are saying that IFRS 16 represents a fundamental shift in how leases are accounted for, moving from an off-balance sheet model to one that requires the most leases to be capitalized. While the new standard improves transparency and accountability, it also brings significant challenges in terms of implementation, measurement complexity, and potential impacts on financial ratios. For businesses, the change may require strategic adjustments in leasing practices, and it could lead to changes in investor perceptions due to the increased apparent leverage. The overall effect of IFRS 16 will depend on the extent to which companies lease assets and the strategies they adopt to manage the new accounting requirement. Thank you so much for